Hello and welcome to the video about executing a trade, a very important aspect of your trading. So let's take a look at what you will learn in this video. What is the bid and ask, where you can buy and sell? What is a spread and essential cost information? Trade the market, the mechanics of it, how to work orders, a very crucial aspect for getting the best out of it. Trading multiple markets, key to your success. So how do you start putting on a trade then? There are only two options when trading the markets, to buy and to sell. You would think that this makes trading an easy pursuit, but it is generally not the case. The act of buying or selling can be as simple as clicking your mouse. All the hard parts of trading come after this. There are only two directions which the markets can follow, but you should also bear in mind that there are certain strategies which take advantage of volatility breakouts or market complacency. But they still fall under the same principle. It will either go up or down, and not necessarily in this order. Trading will also depend, much like any other form of commerce, on supply and demand. It is not to be viewed as gambling, but rather as a form of an intellectual game, one that entails risking your own capital. So it is considered by many both an art and a science. When executing a trade, one should bear in mind that there are different ways of entering the markets. You can trade where the market currently is, or you can wait for predetermined prices for the markets to trade up and down to. You may have heard the phrases buy or sell at market and working orders. This describes the two options above perfectly. Bear in mind that any financial instrument is quoted as a bid and ask spread. You can see that at the screenshot to the right, where price spread is quoted as such, a bid and ask. Bid is where you could sell, so effectively where other participants are willing to buy, and ask is where you would buy, so where other participants are willing to sell. There is also another element which refers to volume and price depth, where you could also see the market depth, as we call it, that is, orders behind the best bid offer. The foreign exchange market as a standard does not face issues of liquidity anyway, so seeing the depth is considered to be redundant in many cases from a novice trader's point of view. There is a 5 trillion turnover every single day, so failing to execute even the largest of the positions is highly unlikely. Having said that, you should be aware that there will be times during which the larger spreads or scarce availability make it more expensive for you to trade. For example, trading the euro-dollar in out of hours in very late in the evening when respective underlying markets are closed for business. The bid and the ask or offer is as discussed where you can currently buy or sell the markets. You will buy the bid price or sell at the offered price. The difference between the bid and ask is known as the spread as mentioned above. This is effectively the charge that brokers put onto the markets to make money. This means that every trade you do, you have to pay your broker the spread before you can make profit on the trade you place. The spread charge is the same if you buy or sell. You appreciate then that in principle this is a business which you start with a negative mathematical expectation, a key feature in markets. To put it simply, you start with a disadvantage, although a very small one, as you have to break even first with the commissions that you pay, which are represented in this spread. Sometimes you will find that this spread is all that you pay, and it comes as a fixed one. But other times, the spread might be lowered, but you're asked to pay a commission on top of this every time you place a trade. These are the options that the brokers will offer in general. The good thing is that there are no hidden costs when it comes to trading FX, so that you can focus on your trading execution. Spreads, as you can see, are an inevitable part of trading. Why would you expect your broker to let you trade for free? Some brokers, you will notice that they will give you free access to live tradable prices or pay bonuses, but this will certainly be for a limited time only and in the context of a specific promotion. Once you understand if you want to buy or sell, it is always good to get an idea of the spread charts. This will tell you how risky or volatile the product is, as higher spreads equate to more risk. Remember, this can be fixed or adjustable according to the market movement. Also, you can work out how far your trade will have to move before you make any profit. There are currency pairs which have very tight spreads, such as the euro-dollar or the dollar-yen, but there might be many other currency pairs, the so-called exotic, which will show a much larger spread. Be sure you understand what the risk is there, as this is one factor that tends to be underestimated. A bigger spread will mean a tougher exit point, right? At the example here, the euro-dollar is quoted at 1.10139 to 1.10149. So if you wanted to buy straight away, that is at the market, the best available price at that specific moment is at the ask, that is 1.10149. And if you wanted to sell, the best available price would be the bid at 1.10139. This represents a difference of 0.0001, or in other words, a 1 pip spread, the smallest increment by which a currency can move up or down. We examine in a separate video how this is calculated. Now that we understand what our base cost is and our minimum break-even point, the 1 pip in the example before, we should take a closer look at execution. Buying at market is admittedly the fastest way to put on a trade. You're willing to take what is available at the moment as the best price. The advent of machines in the past 10 years has made this possible so you can trade more effectively. If you enable one-click trading, you get the bid, ask, or buy and sell buttons directly on your charts. This means that you can look at the chart formations while trading. This facility is enabled on your trading software and you can choose to activate it. However, it should be made clear that only if you are experienced will you use this option, as incidents such as fat finger can result in unnecessary losses. In the example provided, you can see that we have marked with a frame the option of one-click trading, but you can also see the depth of the market that we discussed before. On-screen trading. Once you have the button on your charts, you can take advantage of speed. You can set up multiple charts and therefore many products at the same time. All the information you want about that product is clearly displayed for you. You can choose to long or buy the bid, or short or sell the offer at the click of a button. This is known as one-click trading. If you do not wish to trade in this way, then the system can be set to, when you press the buy or sell button, give you a warning or confirmation that this is what you really want to do. We strongly advise you to take this option, which is given by default, before you move into the more advanced one-click trading, although the latter will give you an edge as your trading skills improve. By choosing to trade this way, you can arrange your screens to trade as many products as you feel comfortable with. In this example provided, we have brought up 4 products, so essentially 4 different exchange rates. Now, that does not mean that you should necessarily trade all of these. But traders often use what we call a cross-sector analysis or correlation between different exchange rates. That is to say that they examine the behavior and impact that movements in one currency pair can have on performance of another. This is common as markets are interlinked as their economies are. Take for example the dollar-yen. This is considered to be a currency pair of the utmost importance when trading FX. It will many times act as a warning of whether traders in other markets as well are more prone to risk-taking or not at that time. This is because the Japanese yen has been traditionally viewed as a safe haven, so one would expect inflows to yen when the markets turn nasty. And that in turn would cause other currencies or sectors to face uncertainty. And vice versa. People would be willing to short the yen, in simple terms, as this is currently a cheap way of borrowing money, which they can use to finance and produce higher returns in other markets. This is the mechanism behind it. This is just an example, as there are hundreds of other examples which one should examine on its own. Another notable example is the relationship between gold and the US dollar, as the former is expressed in US dollar. What that means is that in theory, because markets do tend to surprise us, a fall in the dollar would cause a rise in gold and vice versa. Since you are able to trade or monitor all these products in one multiple screen, this will make you more informed and therefore better equipped to beat the market. The Market Watch will allow you to select any FX pairs, indices or commodities you wish to trade. From the active open chart windows, you can then buy or sell when the markets meet your trading strategy. You can see the ordered window open in your next slide within the multiple screen. This can be from the technical chart setups, or it can be from any new fundamental information you may come across. This is a very reactionary style of trading and placing trades. It is the quickest for getting access to many markets at the same time, one that requires experience. Let's now take a closer look at how the ordered window can help us with our trading. Working orders in the market is another way to place trades. This is less of a reactionary style of trading. You're not trading where the market currently lies. You are setting up orders to be executed in the future when the price hits a certain high or low. This would be around areas of support or resistance or previous highs or lows, for example. What you're trying to achieve by working orders is to take the noise and movement factor out of your trading and to pick good highs to short and lows to buy. Back to the old trading term of buy low and sell high if you follow that school. The principle of working orders is the same as trading at market. You want to buy or sell a particular price in a particular market. The only difference is time. When trading at market, the time to buy or sell is now. You have limited choice. When working orders, you have more time. You wait in essence for the market to come to you. Not until the price is traded will your execution be done, and therefore will you buy or sell. This is especially helpful when you are following your trading plan and when your analysis has pointed to a certain entry or exit level. This is probably not the one offered by the market right now. A working order is also beneficial, or better said, indispensable, when one sells or buys a position in tranches, doing so in his or her effort to get the best price from the market. This is the different aspect of trading at market and trading for the future movement. Take this hourly chart, for example. So if you want to sell high, then the high point of 1.10674, as depicted in the graph, was 8 hours ago. The current price, or market, is 531 pips lower. If you want to buy the previous low, then this is 610 pips away, so you may have to wait 8 or more hours for that low price to be traded. The only other option is to trade where the market is now and buy, expecting a bounce to the previous highs, or sell down the previous lows. So you can see the flexibility that working orders give you as opposed to market orders. Professional traders do tend to use working orders. As you might have concluded by now, trading is really a personal thing. You have to decide if you like the action of trading at market and making trading calls right there in the moment. You may prefer to wait for the market to move between support and resistance before you buy or sell. Trading is all about finding value and matching your trading style and risk to a particular market. Working orders give you flexibility, as you can set these orders and then don't now have to constantly sit in front of the screen. You can wait for the markets to come to you. Remember, you're choosing these as maybe a part-time profession or something that can enhance your portfolio performance, but it needs to be liberating. Trading at market allows you to trade multiple markets very quickly and take advantage of short-term price movement. Both styles have their benefits and drawbacks. There is no guarantee for success. It is down to you to use the tools that your broker provides to best suit your trading needs. And this is why planning before you trade helps you get the confidence you need. Most people fail to realize this. After today, you will not.